My name is Mark Su, and I'm a CFO and have been helping companies raise money and raise funding for quite some time. My background is actually in engineering and Wall Street. And today we're going to have an exciting interactive discussion on how to raise money for your startup, understanding the sources of money and understanding just the whole journey from idea formation all the way to a potential exit. And I'm super excited to have my colleague Adele Hogan join us. Adele?
Thank you. I'm Adele Hogan. I'm a partner at Broadfield, and I've closed over $200 billion worth of deals, but it's lots of small companies in there, as well as obviously some big deals. And I do securities and M&A. And I also have worked on over 30 bankruptcies and restructurings on the corporate side.
Excellent. So let's get started. And this will be a guided journey in terms of an infographic. And if you have questions, put it in the chat window and Charlotte will collect them for us. Okay, so welcome to our session on our guide to raising money for your company. And this is important as we support CEOs. And sometimes we might have initiatives of our own to kind of grow our own company. But at the very root level, this is where money comes from. This is the money tree, and this is the sources of funds. So in it, we have friends and family, crowdfunding, angel funding, family offices that we'll talk about today, venture capital, corporate ventures, also non-dilutive capital coming from grants. There are also large sovereign wealth funds. I mean, think about what's happening in the White House today. These are mega funds from other countries. There are SBA loans and also bridge loans and lines of credits and also mezzanine financing when it comes to debt financing as well. Just an interesting thought. When you look at some of the successful companies today, look at Amazon. That was when Jeff Bezos actually borrowed from his parents $250,000. Google got started from a friend. His name was Andy Beckhamstein, who actually wrote the first check, $100,000 on the porch in Palo Alto. And I think that $100,000 investment has actually done quite well. And if you look at even like Whole Foods, John Mackey and Renee Lawson, they borrowed $45,000 from their family members. So that was the early check that they got at Whole Foods to get started. LinkedIn, friends and family, people who invested in PayPal, he had a good exit. GoPro borrowed money from his mom and his parents, and his dad, and even Under Armour, something, that was from friends and family. So big companies can get their start. And I'd be remiss if I don't add Spanx into the mix. That's Sarah Blakely. She used $5,000 from her personal savings and some money borrowed from her friends and family to get started in our our underwear business. So let's look at the landscape. And so when we look at the VC landscape, we have large venture funds, we have mid-sized VCs, we have mutual fund VCs, and we also have corporate ventures. So large VCs, for example, the popular ones would be A16Z, Andreessen Horowitz, for example, Battery Ventures, Sequoia, which is very famous. And then you have mid-sized, such as the Menlo Partners, Shasta, Trinity, and you also have large mutual funds that are also investing in early stage companies. So that would include Fidelity Ventures, T. Rowe Ventures, and BlackRock Ventures, for example. Corporations are also very active. So you have big technology companies also investing in companies. Adele, any experience that you've seen across the gamut in terms of the types of VCs that are out there?
Yes, I've found that corporates right now are quite active. And I'm actually in the middle of negotiating one with one of the big tech companies that you would anticipate, even though this is a smaller company that we're going for.
Yeah. So a lot going on right now, particularly as it relates to technology and in AI. Now
Uh, On,
there's,
on
go
the
ahead.
tech, on the technology and AI front, I have a number of smaller companies that have all pivoted to make it clear that they really are a platform or a technology-based using AI type of company. So whatever they're solving for, that's the backbone because that's where they're able to raise capital.
Yeah, and that's an important comment because as we talk about later in terms of positioning a company, I feel that these days if you don't have an AI strategy, that's going to cost you in terms of attention and valuation. So very important. So let's turn to another source of capital, which is debt financing. So there's borrowing money from the bank. There's also venture debt. Sometimes ventures will also do debt as well. Sometimes there's revenue-based financing, convertible notes, and mezzanine financing. We'll dive into each one into a little bit detail. But Adele, can you give us an example how sometimes companies will round out their financing with a little debt as well?
Absolutely. It's good because it doesn't dilute the owners. It's just straight debt. So that's a very attractive feature. People are also using what are called safes, which are simple agreements for future equity. I know this, it's, we can talk about it on the equity part of it, but it's 60 to 80% apparently of seed stage deals worldwide are using these safe um, documentation, but only less than 2% of the very big mega companies have used that method. The friends and family method that Mark was talking about is much more common, certainly in the older, more established, larger unicorn type companies.
Yeah, that's a good point because when you don't know the future value and things are moving very quickly, sometimes a safe note is actually the right way to go. So what are we trying to achieve? Companies are growing, but the thought is it starts with a idea, and I've seen a lot of napkin drawings, for example, when I talk to founders, and the ideal can grow. It can grow into commitment. Eventually, there's a product, and there you want to go discover good product market fit as you think about how do I change and solve a customer pain point. Subsequently, then it's improving and honing your go-to-market. And then once you have that refined, it's scaling the business. And then that's when you call, when you're doing really well, things are going fantastically well. You call Adele and say, I want to go IPO or I want to go to do an M&A transaction. But this is the life cycle of a company. In tongue in cheek, I wrote it from zero to hero. And you'll notice that it's not very linear. Adele, you've seen it, right? It's ups and downs for companies getting to a successful outcome.
No, that's why I'm a huge proponent of helping small companies. And even some of our largest, most important companies in the United States had terrible times where they could have gone bankrupt or it was an awful situation. So you just have to grit your teeth and get through it. And that's where people like Mark and myself, we try to help the companies through, good times, but also the difficult steps. Also, I wanted to just give the normal warning that this is really for teaching purposes, and all the examples we're giving aren't legal advice. We're just sort of issue spotting throughout.
Yeah, good point. I mean, some of I remember like Tesla was just about to close its doors. They were going to miss their payroll. That was Airbnb had a really big challenge in the early stages. Many companies go through pretty much life and death situations, but sometimes if you grit your teeth, like Adele pointed out, you will actually can make it to the other side in a big way.
Also, I'm a big advocate for letting investors decide. So, Massachusetts, for example, blocked Apple's IPO. They wouldn't let shares be sold within their state. And, I think investors should be able to get the materials, make their own decision, and, look for the opportunities and evaluate the risks.
Yeah. Another one that came to mind is Netflix. When they first got started in 2000, in the early 2000, they were actually very close to not making payroll. So they had to quickly pivot their business, and now they're doing kind of okay. Okay, let's look at the top VC firms out there. And you'll notice that, let me just move the screen. The big ones that everyone should be aware of include Sequoia, Andreessen, Kleiner, Benchmark, Greylock, Bessemer, Tiger. Tiger actually got very big very quickly. And there's also Union Square, Foundry. And these are some of the companies that have, and the investments. I mean, Sequoia, Apple, Google, Airbnb, WhatsApp. That's not a bad outcome for some of these companies and their early investments. So think about, your $5 million investment growing to almost $1 billion. That's not bad. Um, e- uh, I remember when YouTube was acquired, the thought was, oh man, $1 billion, that's way too much. But as itself, YouTube is probably worth about $500 billion just in itself. So, and also same thing for Instagram, $5 billion for Instagram. I mean, that is really transformed Facebook. So Meta. So those are some of the big ones. Let's move to corporate ventures. So, in addition to regular VC firms that have general partners and limited partners, you now have corporate firms investing early in technology. The ones that we are familiar with in the past are, Intel and the work that they've done, investing in companies such as Red Hat, Cloudera, and Data Robot. But also Cisco is active, BMW is in there, Sony is in there, Apple is in there. You have SoftBank also with many different divisions investing. And the big one right now is NVIDIA. NVIDIA is actually, um, they are printing cash and they are investing in a lot of startups, including Anthropic and CoreWeave, as we continue to scale AI.
So
Adele, what's been your experience in corporate ventures?
yeah, so one point on the AI, because I did a de-SPAC merger of an AI company that then got into some financial troubles. You really have to watch the AI, and you have to watch what's sort of like a round tripping or a situation where within the industry they're all buying or vendors to the other companies in the AI ecosphere. And that's what's causing Michael Burry and other professionals to say there's going to be a pullback in that area. It doesn't mean it's like the internet when we had the internet bubble. It's not like it's not an incredibly valuable service that's going to be transformative. It's just do we have the right amount of debt on it that's going to be able to realize the returns that our people are talking about. And remember, we've got the U.S. government bought a 10% stake in Intel, and we're just seeing, I think, even ChatGPT's or AI uh, came out and said like, oh, well, the government will bail us out if we get into trouble, things like that. I mean, there's just a lot going on in this space. So we are very careful if there's AI in a company, which in most cases is the case now for companies that I'm working on. We
Yeah,
do not we do not want AI washing, which is like greenwashing. We do not want to overstate what the AI is doing. Just like for greenwashing, we don't want to overstate the climate benefits of a company because the SEC will come after you for that, and so will
yeah.
investors.
And that's a good point. I mean, investors they're smart. They'll know if you took a legacy company and just peppered it with AI. So they will really look into that. Um, and if anything, look at the I think it was Oracle's credit default swaps recently. That's kind of flashing some early signs of maybe there's an over enthusiasm. We do think AI is very powerful. However, you do need to have a little bit of a critical eye when it comes to evaluating companies and investments.
A lot of
We have a question in the, I'm sorry, I didn't mean to interrupt. I don't know how I should be doing the questions.
Go ahead.
So any of those VCs targeting industrial slash manufacturing companies as opposed to software?
Um, Little less so, because of the capital intensity in manufacturing and industrial. Adele, maybe if you've seen some, you can suggest. But I do see in certain areas where real big pockets of growth is defense tech. That's really, they're seeing a lot of opportunities there. And anything related to powering data centers and even like um, look at the resurgence of nuclear, for example. So there is, it depends, but I think what investors typically like are asset-light businesses and less capital intensity. Adele, you have a thought on that?
I agree. In fact, I have an excellent company that I think is going to be very valuable, but we really had to pivot and emphasize the AI software platformy type piece of it, even though it is a capital intensive business, because without that hook, it was just too hard to get investors to engage. But we're good at that. I mean, Mark's good at that. We're good at helping companies craft a story that's attractive to investors and get the capital in the door.
I see what looks like two comments. One is maintain X as software for manufacturing companies, and another one was financed by Bessemer also.
Yeah. And so I think it all depends. I mean, look where chip manufacturing, nobody wanted to make semiconductors 10 years ago. Now it's hard to get. That's manufacturing, that's industrial. So it all depends on the area, but I do think you need to be tied to a secular growth story, which happens to be at the moment AI.
The other area where industrials are getting a lot of attention is anything related to power. So because these factories and data centers, et cetera, require so much power, people are building on grids, and there's a big look at that. There's also a big look at water supply. So, for example, there was a chip, a multi huge chip factory that's supposed to go into a particular location, and some of the factors that went into that is obviously the labor force, but also the quality and abundance of water and power.
The key point because if you look at data centers, and you look at a rack, for example, for these advanced GPUs, 80% of the weight and the system requirements is related to cooling down the GPU. So you need power, you need water, which is why we even have very early companies thinking about data centers in space and powering that because then you don't have a lot of the challenges here. But power requirements and subsequently even critical materials requirements are actually very high.
Mhm.
Next question is, do you know of any VCs that focus on pre-revenue medical devices?
Yes, and we'll go back to the specific details. Let's in the end as we kind of combine all that, Charlotte. Let's move on to convertible notes. So
One last question it looks like on this topic. How do we get in touch with some of these corporate ventures such as Amazon
yeah, well,
Alexa?
that that you need to actually there's a lot of there are sources, but you will need to actually do some rolling of the sleeves and finding the right person to talk to. And they're actually out there presenting at conferences, and they have a big profile on LinkedIn. So we'll leave that up to you.
If you contact Mark or me, we can also try to help you a little bit offline.
Yeah. Convertible notes. Let's talk about sometimes we don't really know the future value. You might use SAFEs, but yet there's convertible notes are still very popular. So talk about your experience with convertible notes, Adele. And remember, the key terms are kind of like principals, interest, maturity date, conversion triggers. That's important because you have to think about what is the qualified event that converts that debt into potential equity. Adele?
Yes, this is a situation where you definitely want to keep control of your cap table, which is sort of what Mark's talking about. You don't want to have a situation where they can convert and completely dilute the owners or the founders' shares. So you really have to watch this and watch for what's called PIK convertible, which is pay in kind. PIK, pay in kind, convertible, where the amount of outstanding debt can or preferred can balloon depending on if it's at a high interest rate and it's pay in kind. But sometimes you have to do what you have to do to get a deal done. So
Yeah, you need the money, but however, think about convertible notes. There's always something downstream you need to think about. Um, it's quick, it's easy to do, but it is debt. There are interest payments, and you don't want to scare up the future equity investors because there's just a ton of that potential dilutive securities coming down the road. Okay. Angel investors. So these are early individuals. So there's a past friends and family, but people that will take a higher risk. They don't always need to see a product that's working, but they will want a compelling pitch deck, prototype or a MVP, and a strong team. Usually they're in the absence of a product and revenues, they want to invest in a tried and true team. So think about all the people that are the early cohorts of people leaving OpenAI, starting their own AI company or leaving Anthropic and starting their own AI company. There's a high level of confidence in those people, so they're getting money. So those are individuals that will invest as angels. You do need to be a qualified investor to do that. And typically the check size could be anywhere from 50 to $500,000. Adele, have you seen angels in your past?
absolutely. In fact, at 11 p.m. on Friday night, I was talking to Angel Investor Platform from Australia. So you can get money from all over the place, but you have to be really careful and you have to be compliant with law.
Yeah. And then you know who's a big group of angels that's uh, I've been investing in technology companies. It's actually Hollywood. So a lot of Hollywood folks have actually been investing in angel funds as well and individually. Okay. Let's move to valuation and just the basic terms as actually let's move to company. What are the important factors for companies looking to raise money? For companies, and this is for all the founders and for CFOs and finance leaders supporting the founders, you have to understand valuation. What are you giving up in exchange for the equity? What are your clean use of proceeds? And sometimes that might be a pie chart in terms of where the money is going to go. Sometimes it might be a milestone business plan. You also need to make sure that you have a clean cap table ready before you do go there and just investor readiness in terms of how their money goes to fund future growth of the company. Typically, what you want to see is just kind of being really prepared for when you want to do your pitch because you want to be negotiating and positioning your company as a strong investment case where people can get a good return. And remember, VCs and other people in the early stages, they need to kind of justify a 10x return because of the risk profile across their portfolio. Adele?
I think I agree with everything.
Now, for investors looking at evaluating companies, because for us, sometimes we might be pitched a deal as well, and someone might be asking us to invest in their company. What are the things that we want to look for on the other side? Well, we want to make sure, look, there's nothing crazy in terms of, 500 convertible notes that are done at different rates, right? You want to look at the convertible notes, what are out there. You want to review the cap table. You want to look at potential dilutive securities. You want to look at the growth potential, look at the forecast. As CFOs, we are building for financial forecasts. We've also seen financial forecasts that are a little too rosy, and we've seen companies underachieve. So we want to evaluate that in terms of the other side of it, and also protecting your investment. What are some of the anti-dilution clauses, the liquidation preferences, participation rights? These are things that Adele deals with all the time. And ultimately, it's like, what do I get for my investment? So let's say I'm an individual putting in a check for $150,000, or I'm a VC putting in $5 million. What is my return? What is my time frame? And what is the potential end game? Adele, you want to add about what other investors are looking for?
Yes, they definitely are looking at your pro forma financials and also the integrity. It's very we help companies, and I'm sure Mark does too, help the companies really try to get the basics done because you want your company to look either the same or as a standout compared to everybody else that's coming across their desk. Also, be very, very careful about working with anyone but accredited investors because when you need to go get a amendments and things like that, if you're dealing with a lot of cats and dogs, it's very hard to explain it to them and feel like they are able to make complicated business decisions.
I think that's important because the type of not all money is green, and it's like sometimes you got to look at where that money comes from. You might have your invest people investing in your software company, so they understand the terminology, for example, ARR growth and things like that. But maybe you took money from someone that's in the wine business and they made, they're doing well, but they put in a $500,000, but now you have to explain to them all these things. So just understand that money's not all money comes with the same level of sophistication.
The other thing is if you are going with friends and family, there are certain SEC or securities law considerations. It's better if you're an officer because then you're allowed to solicit in a more liberal way than you are if you're not an officer because you might be a third party. So you definitely need to talk to a lawyer or someone like Mark who's sophisticated to be in compliance.
Yeah, I mean, there's Adele and I, we've seen some crazy stuff. So try try not to save too much money on, I mean, like finance people, we want to save money, but there's always, there are times where you do need to spend the money. Okay, so let's look at pre and post money valuation. So what are the basic terminology? Well, pre-money is before you get the money, post is after you get the money. And then to think about the dilution that occurs and how people, VCs or individuals, they kind of want a certain percentage. Adele, what are we seeing in terms of valuation these days for some of the companies out there?
Well, if you have an AI or tech twist, it's much much better. And people aren't expecting generative AI. I mean, I've been in some private meetings with some very companies you would recognize, and they, amongst a small group of us, will agree that the generative AI is still a ways off. I like to use the term AI or machine learning, like almost interchangeably when I define things, because machine learning is really more algorithmic. It's just like a process that's really numbers. Um, and I think you get into less trouble if you do something like that.
And just to kind of give you a sense, where the equity markets where they are today, software companies, I mean, if you have very good revenue growth and very good operating margins and very good net dollar retention rates, you're looking at potentially 10x forward ARR valuations. The flip side is if you are capital intensive and if your business is cyclical, um, although your margins may be healthy, sometimes it might be a function of your multiple of your EBITDA and everything in between. What you want to show is kind of like in this cohort, I am one of the best positioned companies because investors will see pitch decks all the time. They actually like to say, I see 500 and I see 500 companies a year. I only invest in three, which shows that they're very selective. And so you want to be one of those that are very kind of up and above your peer group in terms of metrics. Adele, you want to add something there?
No, I think that's a good summary.
Yeah. So understand where you are, understand the peer valuation, and valuation is actually just not only a relative case, but absolute. If you can add other things and support it, and uh, there's something important and difficult and valuable and unique that you do, you can actually garner an equity premium.
I just also will add, if you are at a bigger company and you have received, but it's a pre-IPO company, there's a lot of work you can do to get some liquidity in those shares. So I do a lot of the forwards and other kinds of derivatives and other types of arrangements with other investors that want to have access to those private companies. Um, and sometimes they can buy employee shares or interest in their shares and things like that. So if you have those kinds of issues, don't assume you're completely locked up.
That's correct, because sometimes, I mean, it does take a long time to get an exit. I mean, some of these young companies are actually been around for 10 years or they've gone through pivots and stuff. So some of the employees will need some liquidity.
I have a question here. Besides DCF, how are early stage companies being valued nowadays?
Early stage, and we can touch on that briefly. It can go, you can look at, there's relative and absolute valuation metrics, and we like to look at just kind of DCF, but also like forward revenue multiples. And you also want to look at kind of like uh, the growth rate, price to growth. You could also look at the equity premium as it relates to kind of like, is this something unique or different? I have another guided conversation, and this is one called How to Garner an Equity Premium. We'll talk about another time. But there's a lot of different things in terms of valuing your company and benchmarking across industries. But for now, sometimes the initiative will be a multiple of forward revenues as long as you have that revenue growth or ARR growth.
Yeah, I mean, I just met with a valuation firm literally last week on a particular matter, and we talked about the DCF, which is discounted cash flow model, the asset model, and then the third was market value, and that's where you go out and look at competitive competitors, or maybe your industry is so different or so new, you can do it by analogy. It's going to be like Angie's List or LinkedIn or whatever it's going to be. So I definitely have some companies in that ballpark where it's basically a brand new industry. It's going to, I think, revolutionize it and take out a lot of cost. Um, so that's, we're looking
And
at the third methodology.
yeah, and sometimes it could be all of the above or some of the
Yeah.
parts or components of that. So there's a little alchemy involved in valuation. So you do want to but you do want to root it in some metrics. Um, but then getting a premium is really about the scarcity. I mean, having a successful exit is one thing, but having a bidding war I mean, that's when, that's really gets exciting for the equity owners. So let's look at, and this is actually might be a little surprising. So the top sovereign wealth funds in the world. Who knew that the Vikings in Norway have $1.82 trillion in assets under management? They're actually the biggest in the world. So Norway, and I actually updated this before our presentation. I did this a year ago, and it was about $1.5 trillion dollars, and that's not a bad return in a year to add 300 billion dollars. And so these are some of the big firms that actually do invest. And interesting enough, the U.S. government is actually starting to take some stakes in companies as well. But look at the Abu Dhabi Investment Authority, Kuwait. Um, the Public Investment Fund of Saudi Arabia, Hong Kong Monetary Authority, Qatar, and also the National Council for Social Security. Every single one has actually grown their assets in their assets under management, except for Temasek. Um, but I mean, $1.82 trillion in Norway. That's one of the biggest funds on the planet. That is the biggest one. So if you have friends in Norway, give them a call. Okay, let's move to um, term sheet basics. Adele knows this inside out because this is what she sees all the time in terms of term sheets, but some of it we touched on, what is the pre-money valuation, right? People will ask, what's the valuation? What's the investment amount? What's the type of securities? Is it a safe convertible note? Is it a priced round? If so, and if is there a dividend? Is it a cumulative versus non-cumulative? What are the liquidation preferences? Us as CFOs, when we look at the fundraising term sheets, we have to go in and see, okay, well, what's the preferences? Because you have the VCs, you have everyone else, and then you have us as the employees at these organizations. Where are we? What's a full ratchet? What are protective provisions? Um, Adele, there's a list of things to kind of think for. What are some of the important ones that
Um,
you would recommend for
yeah,
people
I
to follow?
just I just had a client over the weekend sign something and we had to get him out of it by late Saturday. So because it's very important that you let a lawyer look at these agreements before you sign up, even if they will do it for free or a discounted rate or something, because in this case, the terms weren't completely spelled out. There was a license that was unspecified, which could have cost the company tons of money. There was an unspecified startup costs, like these companies sometimes charge you money in the beginning. You really 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 have to work with somebody who knows this, and they can often do it very very quickly. It's not a big expense, but it's very important. And on the I see that we have the drag along rights. Usually we also talk about tag along rights. So drag along means, well, the drag along tag along rights means is if we decide to sell the company, everybody has to come. We don't want some outlier that's going to completely nix the deal because they think they can get a higher price, et cetera. If the board or if the majority shareholders think that this is the best deal we can get, things like that, you really have to work out and hash out and make sure you're protected.
Yeah, I mean, there's so many little things, and for CFOs and finance leaders, we don't do this every single day, right? It's only episodical when we do fundraising, when we look and review term sheets. But Adele and her team, I mean, they look at this all the time so they can help organizations navigate through that. Some of the things that, we do want to be aware, look at a little bit in detail is what are preferential rights? What are participating preferred stock, right? There's the term of double dip. There are also overly restrictive anti-dilution clauses. There are founding vesting resets. There's pay-to-play provisions, mandatory redemption rights, and also dilutions via options pool. And how does the options pool gets done? All those little things. Adele, without being specific, can you kind of like give us
Yeah,
some insight? Yeah.
I'll give you another example this weekend. This weekend was very busy. It had lots of different deals. One was on a ROFR, which is the right of first refusal. We were worried that the provision was going to depress the incoming offer, but then we realized that ROFR is only for like a day or some short period of time. What we worry about are ROFRs that are like a month, and then you're dealing with shareholders and they're deciding whether they're in or out. It really depresses the sale price. So you really, really want to be strategic on this, and you want your deal to stand out because it has agreements with good terms in it. It doesn't have
Yeah.
to be the best terms, but you don't want any crazy terms that are going to block your ability to finance your company going forward.
Anyway, in my experience, I've had, where VCs will come in and say, Mark, everything looks good, but what in the world is this that was in from the prior? And that if you upset people enough, they will walk away from a deal. So you don't want anything crazy, complicated, or difficult for a deal to occur. So let's talk about valuation. We all want the highest valuation. We want the least dilution, but it's give get. How do we think about valuation and dilution in terms of the overall context of an investment profile? And the other things that you do want to be aware of, look, valuation, I mean, people, VCs, for them to add private equity, for example, they need to have a meaningful share. So you need to think about that as founders or as a company. You also want to think about valuation so that you grow into that valuation over time. One round of financing doesn't mean the last round of financing. Although you've seen it before where the valuation goes up and down and all over the place as a company does rounds of financing. I'll ask you to speak about that. But also, it's like warrants and convertible notes, right? I've seen convertible notes with various discounts to the future round. You want to keep that clean. I've seen convertible notes where it just gets piled on, and the interest rate might be different for each one. And then I've also seen like people convert promissory notes to convertible notes, and then all those things have to be added up because those are all future dilutive events for the cap table. So you want to kind of be really mindful because ultimately, as the finance head, they will ask you the simple question: how's the cap table? Is it clean? What are the things that I need to watch out for?
Right. You want to look for things like death spirals, which is where more and more shares can be issued or warrants, and it just drives the company right down to no value. So you definitely need floors and ceilings and things like, collars, things like that, that are fairly sophisticated terms to protect really everybody because it's not in anybody's interest to drive a company out.
Yeah.
So I'd watch out for that. The other thing that you can add value, in addition to these very, very excellent terms that Mark is highlighting, are things like governance. Like have regular board meetings with good minutes. That makes an investor feel really good. Oh, these people are on top of it. They're not doing crazy things. They talk through issues. There's little things like that that a company can do that I can see makes a company much more financeable.
Yeah, that's a good point. I mean, look, I mean, part of the data room that we all have worked on is including good financials, but good board decks, good all that information. If you have that ready, prepared, and just solid and ready to go, that's a different story from people are just asking for little things back and forth, back and forth. You inspire confidence that, look, operationally, I've got things nailed down.
That's a
Um,
great.
I'm sorry. It looks like it's a comment more than a question from Jeff. Much like doing an M&A, when you're finished with one, you say, and then in quotes, we'll just do the same thing for the next M&A, end quotes, only to find out the next one is totally different.
M&A is never going to be taken over by AI completely because it's 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 very personal. There's a lot of soft things that go into it, but parts of M&A are people are using tools, AI tools. So that's why Mark's point about the data room is absolutely critical. I hate messy data rooms. I always go in and I want everything perfect in a folder and I don't want gaps. And then because I think a lot of potential investors are using AI to look at the data room and come up with an early valuation of the firm or the company and to see if they want to even pursue it. So you don't want these little foot faults to knock you out of the stream of financing.
Yeah, good point. I mean, if they want to see your customer contracts, it should all be organized in one folder by account, by date, by all those things without duplicates and without amendments. Just be really clean. And that would just, you valuation and all those things, ultimately, it builds on confidence. It builds on just do they believe not only what you've done and the propensity to increase and grow the company over time, and they could be synergistic relationships, but how you're doing things correctly and operationally sound. This, as it relates to founders, kind of what it used typically looks like, and how structures for an early stage company. You have founders, investors, warrants, employee pool. This actually gets people hung up sometimes too, because it's like, well, we're always rounding up the employee pool. Companies never seem to have enough, but it's how do we do that? Do we do it before or is it pre? Is it post? That's something that does come up. So that's something to think about. And also the safe notes. Safe notes are very popular because it's simple. It's not 10 pages. Y Combinator kind of initially started that, but it's getting very popular these days. Anything kind of like what you see in terms of employee pools these days, Adele?
Yeah, I would think 15% is a little high for a typical investor. They might, now that doesn't mean that you can't alter it, and you obviously don't have cash in the beginning, so you're trying to compensate your executives. So you have to play with these numbers and also see what's common in your industry.
Yeah, and it all depends. So it is just a framework. So take a look at that. The other one, I'm going to zoom in here. This is the R word. Um, Sometimes it happens, but we get stuck and we have to pull out the R word, which is the recapitalization. What is it? When does it occur? And how should we think about a path forward for companies? Because sometimes growth is not linear, it's ups and downs. Adele?
Yeah, I do a ton of reorganization and recaps, and that is a very, as Mark was indicating, it's just a very common thing that lawyers and finance people would be working on. It's hard to get a company right. I mean, usually even their businesses changes and pivots as you grow. The other thing I wanted to point out to you guys is there's the National Venture Capital Association documentation, which is often used as, particularly at the venture capital level, as a way to do documentation a little more efficiently or less expensively. So make sure your lawyers are aware of that.
Okay. For stock pools, and then this is something there's ISOs and NSOs, incentive stock options for employees, consultants, part-time CFOs will get sometimes NSOs, non-qualified stock options. Just beware, there are different tax treatments for that. And then as it relates to warrants, sometimes these are offered as sweeteners, but you also don't want this to get out of hand. Adele, what's your experience been with warrants?
Warrants, very important to stay on top of that, and also remember, cheap stock is often a problem if you're trying to do an IPO. So you want to be very careful about not issuing stock to your employees or insiders that's below what other investors are paying, because you're going to take a huge financing hit, and then that will make your company less financeable.
That's a good point. And we've seen that in the news a while back. So it's something to really make sure you do that. And I mean, I've seen companies where, salespeople, warrants, customers, warrants, anyone, janitor, warrants, cafeteria, warrants. You don't want to go too crazy with the warrants. So you want to just take it easy. They are ultimately dilutive. And what investors look at is fully dilutive shares. They count everything. Right? It's like I mean, even public company was like, wow, 150 million shares, but you do the math of everything, and it's like 25% potential dilution in the future. Okay, so equity premium. Now we've done the hard work, we've raised some money. Um, we want a premium, we want a valuation that's higher than others. So what are some of the things to show? Well, one, it's you want to show I address a large addressable market. My TAM is big and it's growing. I want to show strong financials in terms of growth rate. I want to show good gross margins. I want to show improving operating margins. There's something called the rule of 40 that CFOs use, which is growth rate and operating margin trends. And also, if you're a SaaS business, you want to have the correct SaaS metrics, that dollar retention rate, very good LTV, and very low CAC, and also synergies with the potential buyer. we're not all going to see IPOs, but we will see exits. So you want to see that, okay, my technology fits well within this larger organization and their distribution channel and their sales force. So that's very synergistic. And also competition. You want to show that, look, my asset is actually very priced and it can go well at this company, large company, and it can also fit this other large company. And that's how you can raise the equity premium for your company. And customer base, it's great if you're growing, but if you have three customers, that's going to scare people off. So you want a diverse customer base. You want to show very good, you don't want to have 10% customers, and you want to show that diversification growing and improving over time. And also a team that's done it before and that's mindful of exits. Adele, what do you kind of seen in terms of companies where you've seen, hey, they're doing everything right here because of these things versus some of the other lower peers?
No, I mean, I think companies are really trying. They're trying to be compliant and they're trying to do things in a smart way. I don't have any
Hmm.
deficient clients. They're all working very hard to, get on top and hustle to get the financing in.
Yeah. So that's good to see. I mean, it's like it's building a business is not easy. We've seen, companies go ups and downs, right? So it's really once you get there, really I remember NVIDIA back in the day. I mean, this was a company that was just trying to compete against ATI and the graphics processors, right? And then they got lucky with their graphic processors in that gaming market, and they got lucky in the crypto market, and now they're in AI, and look at the worst success they are. So the lesson learned is just to really add value and continue to grow your TAM and expand your ex areas of expertise. Preferred and common stock. These are some of the things that we should be also looking at. And there's also like different classes of stock, class A, class B, class C, in addition to the common and the typical preferred. What's your experience been, Adele, with the different types of classes of stock?
My founders have been much more sophisticated in terms of having different classes of stock. I know sometimes stock exchanges don't like it when you do an IPO, but
Mm.
that has protected their investment. So I think that, Class A and Class B with supermajority is very common in these kinds of high growth companies.
Yeah. I mean, investors will complain they don't like it, but at the same time, if it's a hot deal and it's a good prospect, they'll kind of look at it at Class A and Class B and kind of move on. So it's something for investors to really think about because ultimately you've invested a lot, blood, sweat, and tears into an organization. You want to protect your rights. In terms of investors by stage and specialty, so these are some of the early stage focused VCs. We all know Y Combinator, but there's also Unusual. There's Forerunners, First Round Capital, 500 startups. And then once you're established, then you'll see the bigger ones in growth stage. Your go-to-market has been refined, your sales motion has been improved. And that's when you're going to growth round from Benchmark, Charles River, Founders Fund, for example, and some of these others like Fenrock and Tiger Global. But those like in impact, clean air, energy or things like that, or social impact, these are some of the venture funds as well, including DBL Partners, True Ventures, Partners, and Revolution. So as we think about kind of positioning, we'll look at this section, which is how to make a winning pitch. Winning pitch to not just investors, but to your employees, because you need to recruit and grow your organization. So the components of it, and Adele, you've seen a ton of decks as well. Maybe you could chime in, but what we like to see is kind of like, look, what is the problem? How is our solution address that problem in a new way? What is the market opportunity in terms of dollar size and growth rate? How do we make money from a business model point of view? Why is our product different and unique? What's the traction to date in terms of initial customers? How is our solution working in from a go-to-market plan? How are we getting it to customers? Are we using channels, direct sales force? Is it something that's downloadable, for example, direct to consumer? And then also competition. What does the competitive landscape look like? How am I, is it a new solution to an important problem fighting off legacy, or is it something more nimble and creative, So you want to show that landscape, competitive landscape. Sometimes the competitive landscape might be internal teams doing things themselves. For example, you have a lot of data scientists, but now AI solutions can change that and improve that. So that might be it. And also the history and the track record of the team. And then as the components, you want to have the financials, the investment thesis. What are you asking in terms of the round? What is the structure of the round? And what is the potential use of proceeds? And ultimately, how you are you going to grow the company and then get to an exit? And then you want to have a very strong closing slide. Adele, what have you seen in terms of very good presentations that people can take away from?
Yeah, so my clients have become much more sophisticated on this, and I give a lot of comments because you only have these short periods of time to give these pitches. And if there's something quirky about your company or your background, I don't want, if you only have a 20-minute meeting, I don't want 10 minutes of it explaining that situation. So we definitely try to get the companies cleaned up with good disclosure documents so that the meetings are very efficient.
Yeah, I think you want to have a strong pitch. Similar to your data room, you don't want any red flags. Just really go in strong. You have a very short window of time. Try to do your meetings at 11 o'clock so that people are feeling good and not at 3 o'clock when after they had a big lunch. Um, I actually read some statistics on that. So it's something to really go and prepare. So this is our guide to how to raise money for your startup. Charlotte has a copy. If you would like a PDF copy, send her a note. And if you mind giving us some feedback, a positive comment on LinkedIn for both Adele and myself, we would appreciate that.